Most traders would have entered this gold trade instantly, but I noticed one small detail on the chart. This single candlestick pattern told me something was wrong. I avoided the trade, and minutes later, gold dropped hard. Today, I'll show you exactly how this pattern works and how you can use it in your scalping strategy. When most traders learn candlestick patterns, they usually memorize the shapes. A pin bar means reversal, an engulfing candle means momentum, an inside bar means breakout. But the problem is, a candlestick pattern by itself is not enough. The same candle can work perfectly in one situation and fail completely in another. The location matters. The market structure matters, and most importantly, the reason behind the candle matters. Today, I want to show you how I use one specific candlestick pattern on gold, not as a magic signal, but as a confirmation tool to find better scalping opportunities. The pattern we are talking about today is the pin bar. A pin bar is a candle with a long wick and a small body. The important part is the rejection. The market tried to move in one direction, but then buyers or sellers stepped in and pushed the price back. For example, a bullish pin bar shows that sellers pushed the price lower, but buyers rejected those lower prices and took control before the candle closed. A bearish pin bar shows the opposite. Buyers tried to push higher, but sellers stepped in and forced the price back down. But here is the important rule. I never trade a pin bar just because I see its shape. The location of that candle decides everything. You might be asking yourself how I can get into the liquidity trap without falling into the liquidity trap. That's exactly what I'm telling you. Go ahead, do it. Now let's take a look at my rules. First, I look at the general direction of the market. To do this, I use the 21 EMA. If the price is above the 21 EMA and the EMA is moving up, I focus primarily on buying opportunities. If the price is below the 21 EMA and the EMA is moving down, I focus primarily on selling opportunities. The reason is simple. I don't want to fight the market. After that, I wait for the price to pull back. I want to see the market enter a significant area. This could be a previous support or resistance area, a key price level, or a pullback to the 21 EMA. Then I wait for the pin bar confirmation. The candle tells me the market tried to continue, but it was rejected. That's where the opportunity appears. Well, but not everything is EMA. With this technique, we can get more confirmation and a better trade. Real trade example. Well, now let's check this technique on a real gold trade. Here we have the gold or XAUUSD chart. At first glance, many traders were probably looking for a buying opportunity. Why? Because the price had started to reverse after a downward movement and formed several bullish candles in a row. But I'm not in a hurry, because I have an important question. Is this a real move or just a trap to get liquidity? So first I start to examine the market structure. In this area, the price had already reacted to a certain range several times. This means that many traders probably placed their stop losses here. Now something interesting starts happening. The price makes a quick move up. This is a major confirmation for your entry or loss. At first glance, this looks like a bullish breakout. Many traders would go long right now. But I'm waiting, because what I see raises a question. Can this move turn into a loss, or is my stop even reasonable, or is this a liquidity zone? If the buyers really controlled the market, why couldn't the price consolidate above this range? A few candles later, a pin bar forms. We have a long shadow at the top. This means the market tried to move higher, but the sellers didn't let it continue. This is not just a candlestick for me. This is a message from the market. The market is saying, the buyers tried, but they don't have enough strength to continue the move. But I'm not going to enter the trade yet. One of the biggest mistakes traders make is that they enter just by seeing a candle. I wait for the next confirmation. After the pin bar is formed, the price starts to break the short-term structure, or the price pulls back, which is the most important part for me. I enter the market here most of the time. This is the best and most confirmed entry point. This is the point where the decision to enter is made. My entry, with the confirmation of the candle and the area, you can even get help from FIBO. Stop loss, it is behind the shadow of the pin bar, but here it is very short, so a little higher or behind the area. because if the price goes back above that area, it means my analysis was wrong. Trading objective: the nearest area where there is a possibility of liquidity. Take profit: an area that has liquidity or is the trading ceiling. Now, what is the result? After the entry, the price started to move down, not because the pin bar was a magic candle, but because of a combination of several factors: liquidity grab, failed breakout, price rejection, short-term structure change. And this is exactly what a professional trader looks for. He doesn't just see the shape of a candle, he reads the story behind what happened in that candle. The mistakes traders make with this pattern. The most mistakes a trader can ever make or do now. Now you may be wondering, if the pin bar is so good, why do so many traders lose money with this pattern? The answer is simple: because they only see the appearance of the candle, not the reason for its formation. The first mistake: trading every pin bar. Not every long shadow is a trading opportunity. Sometimes the market is just moving in its normal direction and forms a candle with a long shadow. But this does not mean that the price is reversing. A pin bar becomes valuable when it forms in an important area, where the market has already reacted, where there is liquidity, and where we have a logical reason for the price to reverse. The second mistake: entering too early. Many traders enter as soon as the pin bar closes. But here's the problem: the real move may not have started yet. Sometimes the market will come back to the same area after the pin bar and even hit the stop. That's why I always look for confirmation. For example, a small structure breakdown 2, a pullback from a significant area 3, or confirmation of buying and selling pressure. Waiting may cause you to miss some opportunities, but in return, you will stay away from a lot of weak trades. Mistake number 3: placing the stop in the wrong place. One of the most common mistakes with this pattern is placing the stop loss too close. The trader sees a pin bar and places the stop just a few pips below or above the candle. But the market makes a small move, hits the stop, and then moves in the same main direction. The stop should be where your analysis is no longer valid, not where you just have the smallest possible loss. And the most important thing: the pin bar is not a strategy in itself. The power of this pattern comes from combining it with market conditions. A professional trader doesn't ask, "Is this a pin bar?" He asks, "Why is this candle here? Is liquidity taken? Is the market structure logical? Have the buyers or sellers really lost control?" That's the small difference between a random trade and a planned trade. Remember this: we don't forget about risk management. Even the best setups fail. That's why the stop loss must be clear. The risk of each trade must be controlled. And no trade should let our emotions take control of the decision. We get confirmation of entry. We don't just say, "I saw a pin bar, so I'm going to enter." If we were to summarize the whole method in one sentence, a pin bar by itself is nothing. But a pin bar in a key area, after getting liquidity and confirming the market structure, can be a powerful tool for scalping gold. They wait for the moment when the market gives them enough information. If you like, in the next video I can test the same technique on 100 gold scalping trades and see what the real result is. If you like this model of real analysis, subscribe and write your opinion in the comments.